Warren Buffett's late business partner and Berkshire Hathaway vice chairman Charlie Munger built his fortune through a philosophy that directly contradicts modern get-rich-quick culture. Unlike flashy investment gurus promising overnight wealth, Munger advocated for getting rich slowly through rational decision-making, patience, and discipline. His approach provides a reliable framework that has worked consistently across decades of market cycles, prioritizing long-term financial security over short-term speculation. The fastest way for the middle class to become millionaires is to do it correctly the first time and not waste time trying to build wealth incorrectly and too fast. Live below your means, the foundation of all wealth building. The cornerstone of Munger's strategy centers on spending less than you earn and investing the difference. This principle requires genuine lifestyle discipline, but creates the foundation for all future wealth accumulation. The mathematics are straightforward. Every dollar not spent on unnecessary consumption can be redirected toward wealth-building investments. This approach doesn't require dramatic income increases or complex financial instruments. Small spending reductions consistently applied over time create significant investable capital. Munger maintained relatively modest personal spending habits throughout his career, demonstrating that wealth building comes from accumulation and investment rather than pretending to be rich through lifestyle inflation. The key lies in distinguishing between wants and needs, then systematically reducing expenses in the wants category while maintaining quality of life. Buy quality and hold forever. Munger's investment philosophy centered on purchasing shares in exceptional companies and holding them indefinitely, describing the ideal holding period as forever when you own pieces of truly great businesses. This strategy requires identifying companies with durable competitive advantages that protect their market positions over decades. Quality businesses typically demonstrate consistent earnings growth, strong management teams, and market-leading positions. The psychological challenge lies in maintaining these positions through inevitable market volatility. Munger understood that short-term market fluctuations are irrelevant when you own pieces of businesses that grow consistently over time. This approach allows compound growth to work uninterrupted. Index funds, Munger's recommendation for average investors. While Munger possessed the expertise to select individual stocks successfully, he consistently recommended broad market index funds for most investors. This recommendation acknowledges that successful stock picking requires extensive research, business analysis skills, and significant time commitments that most people can't provide. Index funds offer instant diversification across hundreds or thousands of companies while maintaining extremely low costs. Historical data demonstrates that broad market indices have delivered consistent long-term returns that compound effectively over decades. The low-cost structure means more money remains invested rather than consumed by management fees. This passive approach removes emotional decision-making from the investment process, eliminating the tendency to buy high during market euphoria and sell low during panics. Develop multiple income streams through continuous learning. Munger placed enormous emphasis on lifelong learning as a pathway to increased earning capacity. His philosophy suggested that developing expertise and valuable skills creates opportunities for additional income streams beyond traditional employment. Rather than seeking quick financial fixes, this strategy builds long-term earning power that compounds throughout a career. Munger was known for his voracious reading habits and broad knowledge across multiple disciplines. He developed mental models that improved decision-making and problem-solving abilities. These enhanced capabilities often translate into career advancement, consulting opportunities, or entrepreneurial ventures that supplement primary income. The key lies in choosing learning areas that align with market demands and personal interests, creating sustainable competitive advantages. Avoid wealth killers, debt, and speculation. Munger consistently warned against two significant wealth-building obstacles: excessive debt and speculative investments. High-interest debt, particularly consumer debt, creates mathematical headwinds that make wealth accumulation difficult. The compounding that works in favor of investors works against borrowers, making debt reduction a priority before serious wealth building can begin. Speculation, whether in individual stocks, cryptocurrency, or other trendy investments, represents gambling rather than investing. These approaches may offer occasional spectacular returns, but they more often result in significant losses that set back wealth-building progress by years. Munger distinguished between speculation and investment by focusing on underlying business value rather than price movements. The power of starting early. The mathematical advantage of starting investments early in life cannot be overstated. Compound growth requires time to reach its full potential, making early action more critical than perfect timing or significant initial investment. Even modest monthly investments begun in one's 20s can grow to substantial sums by retirement age. The difference between starting at 25 versus 35 can represent hundreds of thousands of dollars in final portfolio values. This principle helps overcome the "I don't have enough money to start" mentality that prevents many people from beginning their investment journey. Market timing has proven difficult even for professional investors, making consistent investing more critical than clever timing. The reality check: wealth building takes time. Munger's approach typically requires 20 to 30 years of consistent saving and investing to reach millionaire status from middle-class starting points. This timeline reflects realistic expectations based on historical market returns and achievable savings rates per middle-income earners. 20 years can go by fast if you start at 18 and reach millionaire status at 38. The more frugal you are and the better the investments you make in individual companies, the faster this process will go. The process isn't exciting or dramatic, which explains why it's often overlooked in favor of more sensational approaches. However, this methodical strategy has proven reliable across different economic environments and market conditions. The timeline can be shortened through higher savings rates or above-average income growth, but the fundamental principle of patient, consistent wealth building remains constant. Understanding and accepting this timeline helps investors maintain discipline during inevitable market downturns and economic uncertainty. The key lies in starting the process immediately, rather than waiting for perfect conditions or larger beginning amounts. Charlie Munger's blueprint for middle-class wealth building prioritizes discipline, patience, and rational decision-making over flashy investment strategies. The path involves living below your means, investing consistently in quality stocks or index funds, avoiding debt and speculation, and allowing compound growth to work over decades. While this approach won't create overnight millionaires, it provides a reliable framework that has worked throughout modern financial history. The strategy requires no special expertise, complex financial instruments, or perfect market timing. Success depends on starting early, maintaining consistency, and trusting the mathematical power of compound growth. For middle-class individuals seeking financial security, Munger's time-tested principles offer the most reliable path to millionaire status through disciplined wealth building rather than financial speculation.